We're not going to run that. We can post the question, Joe. Hello, everyone. Welcome to our next session in the series of Book Business 101. For the people in the room, we've got another 100 people online on our Teams meeting. Okay, for the guys online, please be aware that we've got the room's growing. There must be about 15 people now. So any sort of questions you have, either just type it in the text. Don't unmute yourself and start speaking. It's going to interfere with what we're doing. Okay? Here, guys, if you've got a quick question, just ask. I'll give you the mic, and you can ask it so that the guys online can hear you. Okay? Perfect. Perfect. So as you can see, today we're doing, I'll take it back a step. Why is it not clicking backwards now? Give me a second. I'm being a bit slow. There we go. So we're discussing management accounts and taxation. So if you guys were here at the earlier sessions, we went through the whole process of starting a business, registering a business, bookkeeping, and things like that. The whole sort of cycle of owning an actual company. One of the key things is management accounts, because it helps you understand your company, and obviously taxation, because who actually wants to pay tax? I don't think there's anybody who, voluntarily puts their hand up and says, take my money. None of us. So we want to go through that because your management accounts and the tax you're going to be either paying or not paying. That's where you can actually figure it out. You can see it on a monthly basis. Okay. Remember, of course, tax only gets paid at the halfway point of the year, August, and then again in February. That's when you do it, like if you're doing your RP fixes. But management accounts you should do every month. The bookkeeper should be doing your books every month. And that will then allow you to obviously understand whether you're making a profit. If you're making a profit, you pay tax. Or if you're making a loss, how to fix the loss in order to actually make a profit. Okay. Does that make any sense? You guys all good with that? Perfect. Alright, we don't know about me. The guy who stands up and talks. We're doing this thing a while. Okay, let's dive into it. Okay, management accounts. A lot of people seem to be unsure what management accounts are. But effectively, it's your income statement. Income statement being obviously sales, cost of sales, giving you a profit or loss. So your income, if you're making income, and your balance sheet. Balance sheet is who owes you money, who do you owe money to. So it's the balances of your books. Bank balance, debtors balance, creditors balance, balances owing on vehicles, assets, things like that. So that makes up your management accounts. All right. So you guys all fine with that? Who of you receive management accounts on a monthly basis? Okay. Any of you? You do. Okay. Then. Okay. If you don't have if you have an accountant, make them give you management accounts on a monthly basis. If your business is too small and you don't have an accountant, you can do your own roughly. Just on Excel, you know generally who you're invoicing. You know then obviously what expenses you obviously and incurring on those like actual invoices, and that'll give you a rough sort of idea of your profit. You then know of your invoices who hasn't paid you, those are your debtors, that goes in your balance sheet, and of the people who've invoiced you, you know who you haven't paid, those are your creditors. So with that, that'll give you a basic idea if you're making a profit or loss. But look at those numbers. Just put them on an Excel spreadsheet, write them on a piece of paper, but every month, track that. Just track it and it'll give you a clear indication where you are on that. Okay, so that's your management account. And everyone will want it. The bank will want them. Anyone who wants to finance you will want them. Someone who wants to invest in your company will want them. So management accounts are a tool internally, but each month's management accounts roll up into your annual financial statement at the end of the year. Okay, so they can track it on a monthly basis. Sure. So essentially, income statement is the same. Sales, that's your cost of sales. gives you a gross profit. But now, what happens is the gross profit or your budgeted amount of sales, that should cover your OPEX, your operating expenses. So what a lot of people get wrong is obviously they just have sales, less expenses, profit or loss. But what you need to do is, there's an amount you're going to pay regardless of whether you make a sale or not. So if you have a shop, as an example, that rent, that phone, the staff in the shop that are there, electricity, water, you've got to pay that month end, whether you make a sale or not. That number, those amounts, must be in your overheads. So it's regardless of whether you actually make a sale or not, you're going to have to pay that. So now your top number, that's like we're using the shop example, your stock and those items will be your cost of sales. So the margin between sales and cost of sales must be high enough to cover your operating expenses. You see? So just bear that in mind. A lot of people don't actually split them out like that. And it's very, very important to actually do this. It gives you a clearer indication as to what your fixed costs are and what your variable costs are actually going to be. All right. Anything on that? Questions? No? There you go. Sorry guys, I'm lying. For some reason my presentation is playing up. Okay, so that's, as you can see now, that's the indication I was talking about. You can have a very simple income statement, or you can have it very, very complex. So depending on your business, and some of the stuff we have covered in previous talks, but it's important to actually and repeat it. So start out here with the simple management accounts. And as you want to understand more things about your business, it'll migrate, not necessarily as sort of too complex as this, but what it'll do is the actual detail will actually increase as you want to know more. So what your management account should do is, at a glance, by just looking at it, you should be able to see the health of your company. You know, maybe my sales must be by actual product, or my sales must be by region, or my sales must be by salesperson, if that's what I want to track, each of my sales staff, my expenses, how do I allocate my expenses? Do I allocate my expenses by region, by actual country, by sales staff? That'll be up to you. And you often find, and accountants will be like, no, don't do that, it's complex. You need to see on your management accounts the health of your company at a simple glance. Okay. Very, very crucial. Okay, so from what I've been through, so these are the purposes of having a management account. Okay. You can decide. You can look at them and go, what sort of decisions am I going to be making? And a lot of times you think, but what choices can we make? So we think we hire a new staff member. I used this term in one of the earlier talks. You're going to hire a new staff member and you're going to pay them 10,000 rand and a month. So you put inside your expense 10 grand and think that's what the staff member costs. Actually, it's miles off. The salary is 10,000 rand. The staff member probably needs a desk. The staff member probably needs some form of administration, like pen, paper, a laptop, if that's what they're doing, or if they in the field, they might need a vehicle. Those things get added on. Where's that? How are you actually making that call? So hiring a staff member means potentially if you're a small business, I've got to take time out of my day to train the new person, which means I don't make sales. How does that actually impact my actual business? So that's why management accounts work. It helps you clearer to understand the actual process of your costs. Okay? Your sales cycle, very few people look at their sales cycle. And if you have all your, I'll go back. but it goes back now. So if you look at these numbers, they actually vary. You see that? How your sales and your expenses vary. It's like waves. So what's quite important then is when you understand your sales cycle and your expense cycle, you can make some better calls. So like for example now, all yours, there was a lady up the road here in Salt Rock who only sold Christmas decorations. Her shop was just Santa Claus, decorations, elves and fake snow. So all the sales happen at the end of the year. November, early like and December. So when did she buy her stock? June. Because who's buying Christmas decorations in June? Nobody. So she got the factories in China and she bought the stuff in June when it was actually cheapest. And she made all her profit at the end of the year. So if you understand that inside your business, you can do the same thing. So for example, if you know, and if I, and that's an extreme example, but it works for anything. It works for absolutely anything. I sell fruit at the taxi rank. I can get up early, I can go to the farmer's market early, get the best fruit, but then I might miss the first passages. And that fruit is a lot more and expensive. Or I can go after lunch. The fruit is just as good, but I'm paying half price. Tomorrow I'm making twice the amount of money. See, so those are real examples. It's not just, for like major retail stores. Even flowers. Flowers are big ones. Buying flowers in the afternoon is half price, as opposed to buying flowers in the morning. But they'll last just as long. So understanding your sales streams and your sales cycles. Look at that. And if you're not looking at those numbers, you're not going to see it. You're going to think you know, but if we all thought we knew, we'd all be rich, but we're not. We sit here and we're learning things every day. Then obviously matching costs and income, very, very crucial. Again, you want to be able to see what sales are making you a profit. So for example, you're going to go and have sales in Durban versus the costs in Durban. Is Durban making you a profit? If it's not making you a profit, and Western Cape is doing it in Cape Town, move all your staff to Cape Town, because that's where your money is. And you can do that, obviously that's a big example, but if you do it in any lineup, I have a retail store, I'm selling TVs, I'm selling beds, I'm selling all sorts of stuff in my shop. By looking at the sales versus cost of sales, I can see which line items are making money. The ones that are not doing it, cut them. But also, it'll teach you other things. You don't have to necessarily cut something. So people might come in, and you might only sell 5 or 6 beds. But the people coming to our beds also buy TVs, fridges, and microwaves. So you're making a lot of money in your TV, fridge, and microwave, but you're only selling a few beds. So if you cut those beds, maybe, you lose all the TV, microwave, and fridge sales. But that'll show you that. You'll be able to see who's buying what line after time. So it's important to match your costs and your income. Definitely helps you understanding your actual company. Okay. And last of all, probably the most important, cash flow. Cash flow is king. Yeah. If you don't have money in the bank, there's a lot of clients who've made a profit on their management accounts, but they don't have any money. And they get this look, but how can I have a profit? But I've got the money, the bank account's zero. How's that possible? Now, if you look at your management accounts, you'll find that your profit, although it says on the income statement, I've made a profit, it's sitting on your balance sheet. Your customers haven't paid you. That's why the bank account's empty. Because the money is sitting at your customer's bank account. They haven't paid you. And you're going to see what that is. And you can see the cycle. Maybe in 3 months, that cash will be inside your bank account. So then you can plan accordingly and go, I'll pay my bonuses. Instead of over the end of the year, festive season, I'll pay my bonuses at Easter. Because you know all your clients from your end of your sales will pay you by the end of March. That helps you with cash flow planning. I can buy my stock off season because of my cash flow planning. I make a higher profit. So that is key as to why you have management accounts. And then, as you saw, they don't have to be fancy. Just jot them down. Excel, piece of paper. But the key is line them up next to each other. March, April, May, June. So you can see the trend, see the movement. That's going to help you a lot. Okay. Anything on that? Yeah. Questions? Get anything online there? No one? I must be getting good at this. Uh-huh. So that's what these numbers do. So that's like a visual. This is like a bit more than what you need, like in the early days. But this is like a visual of what you will do with your management account. It tracks all these things. I mean, this is a tool of ours. A tool that we own. And it tracks things. All your profits, your margins, cash flow, what your sales cycle looks like, what your costs. That's what all comes out of your management accounts. Now I bet you that's a lot easier to see, look at, than all those numbers next to each other. So if you do get an Excel, or like a Google sheet or something like that, you can get it to switch over to a graph. It makes it easier to actually do the graph. But that's what the outcome is, like a visual outcome of your management account. I think this thing goes to sleep. Okay, cool. So management accounts are done. We all understand management accounts. Okay? You sure? I'd love to see your guys' management accounts next time I'm here. Okay? Remember, we're here every month. So pop in, have a look. I'd love to, and we're glad to share our time with you. That's why we're here, for free. So if you have a set of management accounts and you want us to have a look at it, bring them next time you're here. And we'll gladly spend half an hour having a quick look at it. Okay? Perfect. Now the important thing is taxes. What are those main management accounts do? And as you know, there's only two certainties of life, death and taxes. But the thing about that is, death you can't avoid. Taxes you can. You can postpone your taxes, avoid them as long as you possibly can. You can never obviously and evade them because that's against the law, but you can avoid them. And that's the key. You can never actually avoid death. Yeah. So how do you stay ahead of the tax man? One way is to just not tell the tax man you exist and then run and hide. But they've got ways to find you. They're getting smarter now with everything. All our bank accounts are online, so unless everything's cash. So when you buy a car, they want to know who's the guy driving the nice car. If you buy a house, they want your income tax number on the home loan application, things like that. So they can track you how much you're earning. So you don't want to be actually doing that. So how you stay ahead is get everything in place. And we're not talking just necessarily individually, but in terms of your company. So get all your documentation in place if you need it. So all your statutory regulations. Because you know, as you registered your actual company, they automatically gave you an income tax number. They came the same time as your actual CRPC document. So SARS checks that to see if you filed it. Now often we start a company, nothing's happening, we're not making a profit, we don't file taxes. SARS issues a penalty. So you should still just file zero. If you don't file a zero, SARS assumes you're making money. And they come after you, they issue final, final sort of demands, and they want to find out what is there. Okay. Regulatory stuff, if you run a business, workman's comp, UIS, pay as you earn, all of those things. And they grade it according to where you are in your business cycle. If your staff are earning less than the pay as you earn, we have you UIS and workman's comp. Those have to be in there. Later on, it's pay as you earn. If you're earning enough, that if your company's turning over $1 million. So once you've done all those registrations, you actually submit them. Make sure you submit them on time, with the right amount, things like that. Okay, so on time, complete them. Try using the accounting platform. That's very helpful. It doesn't mean you're going to pay more tax because you have an accounting platform. Okay, often we see SMEs pay more tax because the accountant is actually stupid, not because of the accounting platform. Accountants are lazy. Like most of us, they want to do the easiest amount of work and get the maximum amount of money. So, and if you're uncertain about what they should be doing, you'll never know. You'll just go, okay, well, they said I owe X and you pay it. If you've got the money. The only time you moan is when you don't have the money, then they find a way to fix it. And keep your payroll accurate because obviously IP5s get issued. Your staff are going to want to know why isn't it pay as you and paid because they want to claim their actual personal taxes. So register for everything you should actually be registered for. Put it on our time, make sure it's accurate. There are lots of ways to minimize tax. People think there isn't, it's that you just got to pay, but that isn't true. You pay because, not because you're lazy, but because the accountants are actually lazy. You end up paying a lot more. Okay. So these are the things that basically income tax, UIF as I went through, workman's comp, and those are generally in order as they happen. So if you're starting out a business and you're growing it, it'll generally happen in that order. Okay. So to give you an idea, that's a number of forms. The guys who haven't been in these talks, that's how many forms you've got to do. That's why sometimes the accountants charge you a bit more. You wonder, what on earth are they charging you for? That's just the regulatory forms they have to go in. It's quite a lot. Right? So just think about that. And it's obviously depending on the size of your company, it'll actually determine which of those forms you're doing when. Income tax, definitely. The minute you employ one staff member and they're working 21 hours a month, UIF workman's comp, definitely. The rest will based on volume, size of your business, and things like that. Yeah, this is very, very important. It doesn't feel like it in SA, unfortunately, but a lot of countries around the world, they don't just talk about SMEs, they actually do something about SMEs. I mean, unfortunately, our big government talks a lot about SMEs and does nothing. Well, it feels like they're doing nothing. And the reason it feels like they're doing nothing is that the hurdles to get over are so many, and the people you talk to get it done are not actually interested. But there are lots of ways for you to actually get ahead. You just got to take the time, the discipline, and things like that. Okay, so the point of all those incentives is exactly this. Reduce income tax, accelerate your and depreciation. So what these things do is to make it easier to run a small business and to pay less tax. That's the goal. Keep more cash in your hand and make it easier to run your business. We've got stuff in SA that reduces the income tax portion, but the compliance burden, not so much. We're still struggling with all the forms, all the paperwork, and things like that. So there's a small piece of tax law. So this is SBC, Small Business Corporations Tax. And the scary thing is the number of accountants and small business who've never heard of this is frightening, like properly frightening. One of our largest ways of us to gain clients and find clients is this piece of legislation. Like I was asking you about your management accounts. So if you want to join us as a client, the first thing I'm going to ask you for is your last set of management accounts or your annual financial statements. I want to see what your accountant did on your tax. And I can guarantee you now, 90% of them have not applied SBC. And just the basic tax, we can probably get the client back like R500,000, depending on the size of the actual company. But accountants don't think about this. They all think they're going to work at a large firm, working for large companies, large accounting firms, not understanding they're going to work for SMEs like us. That's what they should be doing. So this is very, very important stuff. A lot of people don't follow it through. So these are the rules around being a small business corporation.
We have a question from Victoria. What happens if the company doesn't submit the tax returns and also dismisses employees once their ILP-5 and payslips?
All right, that's a double barrel one there. Okay, so the thing with the forms, SARS has split so the legislation has split the forms by not putting the form in, regardless of what the form, income tax, VAT, Taxation, whatever the regulatory form is. If you don't put the form in, that's a criminal offense. They can send the police, collect you, arrest you. Invariably what happens is not that you don't go to jail, like jail, but they can actually compel you, so they pretty much arrest you, compel you to submit the forms. Because what SARS wants to know is, what do you owe them? That's what they want to know. Because remember, our whole tax system is built around what we tell SARS. It's a trust-based system. So we do the accounting, we fill in the forms, they've got averages and norms that they check against to see who's out of range. That's why you get an audit or things like that. So how do they check if we're doing things? Compel us to put the forms in. So if you don't put the forms in, arrest you, force you to actually submit the forms. Then when you owe them money, unless it's not fraud, that you're not stealing anyone's money, which is obviously a different criminal offense. But now if it's a legitimate expense, you owe SARS the money. Any other trade creditor, make a payment arrangement. They allow you to do that. You can pay off the money you owe. They'll still give you a tax clearance form and things like that. So just be aware of that. So even if you owe money, submit the forms. You'll get a penalty, which is fine. That's your fine for speeding, and you can pay it off. Pay it off over time. That way you can still run your actual company, you can still get a tax clearance, you can still apply for tenders, all of those things. Okay. The other half of the question was they're taking pay as you earn, and then they fire everyone.
And not giving them ILP-5.
Okay, so that's actually more than two. All right, so now the other part of pay as you earn, when the company deducts pay as you earn and not paying it over to SARS, that's theft because you're stealing your staff's money. So you're effectively stealing it and you're not paying it over because you're taking it out of their pay. And why you're stealing it is because when they submit their tax returns, they can get a refund only if they pay tax. If they haven't paid the tax, they can't get a refund. So then they got medical aid, income protectors, RAs, all of those type of things which allow you to get a tax claim back. They won't actually get that. Okay. RP5s, obviously, with those forms we went through earlier, let me see if I can. So with your pay as you earn, you see those EMP 501 forms. So every 6 months, generally April and then September, you will actually submit a reconciliation of your pay as you earn forms to SARS. The final one, now in April, that's just happened now. That final EMP 501 is what tells SARS what your RP5 is. So if your employer has done that, but not given you the RP5, it doesn't actually matter. SARS has already got the RP5 on the system. It's when the employer hasn't done the pay as you earn, hasn't actually submitted the forms, haven't paid it over, SARS will never know that you earned it. There's processes around, you can go do an affidavit with your bank statements proving what your net was, and then SARS goes after the actual employer. You can still claim your taxes. That's fine. Okay, hopefully that answers that one. Okay, so small business corporation tax. Guys, all of you must, if you leave here with nothing else, know if your company is this. Okay, it's important. You're going to save a lot of money. Lots and lots of money. Money that we can all use. Okay, so you must turn over less than 20 million. To give you an idea, you can be a fairly large-ish business and still be considered a small business. So most Most countries around the world, a small business is 50 million and under. Medium size is from 50 to about 250. And then from there, 250 million and up, you get larger, very large corporations and so on and so forth. So 20 million gross income. That's what you should be. Anything under that. Okay? You can't be personal services. And there's two little aspects because there's a little caveat. Personal services are like us as an accountant. I do the work, personal, hairdresser, personal service. The first chef, I'm doing, not a restaurant, but a chef who does I get hired as a chef at parties and stuff like that. A DJ, personal services, things like that. So anything where you, the person, does the job, it's a personal service. However, the caveat is, if you've got 3 or more people that you employ that are not paying, then you actually qualify as a small business. You see, that's what they want to see. So, for personal service, because as a personal service, I can then just actually explain my business. You and the other owners are actual people. You can't have a business as a shareholder. You've got to be actual people. Questions?
That's interesting,
If I'm going to put it in including the interns, maybe if we employ 3 interns, not interns.
So, on the personal services, any 3 or more people that are part of earning your income, part of making your business work. So you can't be, like I can't be me being the actual accountant, then I employ my gardener, my housekeeper, the neighbor's kid. No, that's can't become a check. Someone is part of the business. And they can be the admin lady who answers the phone, does admin. That's part of your business, gets the business going. Can be the sales rep, who's out on the sales. Can be the guy in the workshop who's fixing the tools, whatever you're doing. So 3 or more. Okay? And then all the shareholders have to be people. Okay? So the other thing is, so actual people, and it can be the only business that you guys own. You can't have another business. And the other shareholders, they can't be involved in another business. The business you own is going to be the only one you're doing. Because what happens is, I've got a 50 million rand turnover business. Then what I do, I break it up into 3, 20, 20, 10. Done. No. God says that. It's going to be one business only. But there are ways around that. I can have my wife have the other business. My children can have their other business. Because they're individuals. They can. But I can't be a shareholder in all 3. They have to be individually shareholders. You see. So there are ways around it. There's obviously tax structures, which is what we do. So you can't be involved in other companies. Not more than 20% of your income comes from the professional service. So again, we'll use our example. We do accounting, tax, normal. We've got 3 staff, more than 3 staff. So we tick all the boxes. I do advanced tax advisory work, international tax, corporate structure. 20% of that work, that's personal, like service fees. When my earnings are 20% more than the company's, or make up 20% of the company's total revenue, we fall out of that net. Okay, so, and professional services are something that you're educated with. Architecture, tax, doctor, consulting, professional. You've got a qualification. Okay, something along those. So just, it's not often something we see, but just be aware of it. And obviously you must be ready at 60. Those are the things. And I can guarantee most of us, if you start a company, we're it. We're the company. We're the only shareholder. So we meet all of these things. What you might come across is the personal services side, probably. And when you're hiring people, you're hiring families. But if you meet these, and it's very easy to meet these, that's what accountants must just check. When you meet these, then the picture changes. Then again. Okay. I was going to skip ahead to that one. So if you meet these actual criteria, this is, that's the income tax you save. So essentially as much as 95,000 Rand a year. That's just the income tax. Now you think of this smallest car in SA, like this Jackson Go or maybe there's a Swift. It costs that. That's what it costs, roughly, about 100K. So your tax savings can buy you a new car. Think about you're employing somebody. That's a whole year's income for an intern, maybe even 2 interns. What does that do to actually grow your company? You see? But that's a small beer. That's not even the real stuff. But still, 100,000 Rand a year. I'd rather have that in my actual bank account than paying cars. And that's where the accountants get it wrong. They just go straight line tax. Now it's dropped down to 7%. So this starts out of date. So as of April, it dropped. And they just charge everyone straight line. 28, 27 now. Instead of applying this, look at the actual threshold changes. Massive. So when we meet a client and the accountant hasn't applied small business tax, we go back and calculate. We can go back 5 years from your last actual assessment at SARS. Now I meet you and I tell you, this is what I'm going to charge you for accounting, but I'm going to give you 500,000 Rand in back taxes that you've paid SARS. What's the chances of you not actually signing up? I've just given you half a bar for nothing. I've just paid my services for the next 5 years for nothing. Okay, but that's the small stuff. This is where it really counts. You can actually depreciate stuff. Now, and depreciation is not an expense in the real sense. You don't pay money for it. Like telephone, petrol, that's an expense on your income statement that you're actually incurring. And depreciation is a tax expense on your income statement that you don't pay for. It's a free expense. Now they accelerate that. So if you a designer, for example, you've got 3 staff, you're a designer because it's personal services, those new Apple Macs that they actually do all the work on, those things are 40 to 50K each. Now you write that off. You write the whole 50, 60K. Just like that. It's an expense straight on your income statement. Not money you spent. Lowers your profit, which means it lowers your taxes. All your assets. So if you're like a builder, for example, you've got a bucky, cement mixer, this compactor, all those assets. Those assets are worth $1 million. Start your first year, use brand new stuff. $1 million. End of the first year, half a bar, 50% expense. So you made R1 million profit. You write off $500,000 as an expense. Now, what's your tax? Now you fall into the small business corporation thing, and you're under 550,000. So you pay 95,000 Rand. So you're only going to pay 154,000, 59,000 Rand. But if you left it at $1 million, you're paying 270,000 Rand. Small business tax, understand it. It's not in the income tax side. It's here, in the depreciation side. Now, because you saved R500,000 on your holding company, you saved tax, you've employed another person. You've got another bahaki, another cement mixer because you're growing now. Now, next year, R500,000 again, plus 300,000 from this year. 800,000. Now you make R1.5 million profit. Where are you going with this? Understand it? This is a very good thing. Todd said. Accountants never teach you about this. You understand this, you start making money. So, hold on.
Okay, in terms of depreciation, since first they don't regard as a cash item versus the non-cash item, do they pay back or you just get a credit to your tax?
Okay, so what happens is, it's not a credit against tax. You won't get a refund, for example. Unless you've overpaid tax, you'll get a refund. But what happens is, if you made a profit, then you'll pay less tax. So that's what it comes in your income statement. But often what happens when you're starting a company, you might be making a loss at the beginning. What this will do is it will increase your loss. So your loss gets larger. So instead of making, maybe 100,000 rand loss, because of the depreciation, you're now making 600,000 rand loss on this example. What that does, so you're not paying tax because you made a loss. You only pay tax if you make a profit. But tax is like a book penalty on actually making a profit. So your loss will grow. But then in about 2 years, for example, when you start making a profit, in 2 years' time you start making 100,000, 200,000, 300,000. Your 800,000 rand loss now gets offset against that. So you're now not paying, when you make 200,000 rand profit, your books are still showing 600,000 rand loss. And the next year it'll show if you make 500, it'll show 100,000 rand loss. So you're not paying tax then. Then you only start paying tax in the future. You see? So if you're making a profit now, you'll pay less tax. If you're making a loss now, your loss will be bigger. So in the future, you're paying a lot less tax. Does that make sense? The answer. You guys understand this? Promise you. This is what makes small and medium enterprises grow. How many of you guys have even heard of this? Yeah. Is your actual an accountant and applying it, or do you make them apply it? You are the accountant. Listen to this, lady. Gather around her and ask her the questions. No, but seriously, good. I'm glad that you do. Because so few accountants understand it. And we see a lot of clients. A lot. We probably see, about 100 SMEs a year. So in these sessions, we do this every year for free. And yeah, last year we did about 70. This year we're going to do maybe 100 in total. So we see a lot of SMEs. And we do this stuff, as I was saying, for free, like this. And people come ask us, and the first thing we do is look at your financials. And the number of times you see accountants who had not applied SPC is frightening. Especially when you see that the entrepreneurs struggling for cash flow. And then you find out that they couldn't get a deal because they paid SARS the money and they couldn't finance the vehicle now because their books are all wrong. Their profits are wrong, everything's out. Scary, scary. Then we'll go back and we'll then we'll fix it. So you can go back 5 years. So if you've got annual financial statements, go home today and check them. Promise you, you won't go wrong. Cool. Questions on this? Anyone? Questions? Online? Great. Guys, thank you. Was a shorter session than normal, but a lot of things, I think, as you can see, there's a lot of stuff that's happened. We do, obviously, and record these. We put them onto our website. So go to SME.TAX. Very easy. And we've got videos, we've got our blogs, the brochures. Go have a look at it. The stuff's free. And you'll learn a lot. There's so much stuff. Awesome. Well, thanks a lot. Really appreciate the time. Okay. Enjoy the rest of your day. Thanks, everyone. Thanks. Bye.
Thank you.
Thanks, Ed and team online.
Thanks, Sunil. Thanks, everybody, for joining. Bye.
Thank you, everybody. Have a good day.